how to value a stock and find a stock's intrinsic value. What's going on, guys? I hope you guys are doing great. So in the last few videos, I have talked about how to value various companies using a discounted cash flow valuation. However, I haven't really had the chance to really go through it in detail. I felt a little rushed. So today I'm dedicating an entire video on calculating intrinsic value, and I'm going to do it in two ways. We're going to do it in the way that I showed in the previous video, a simple discounted cash flow, which I learned from Monish Pabrai's book, The Dondo Investor. I highly recommend it. But we are also going to value a stock using Phil Town's Rule 1 valuation. The Phil Town valuation is actually where I started. So if you are new to valuation, then really pay attention, because I really think that is a great way to begin learning about how to value stocks. Additionally, guys, I'm going to leave a link in the description to these intrinsic value calculators so you can have fun learning how to value companies right along with me. One thing I do want to touch on before we jump on over to the computer is that this may seem like a very easy plug and chug kind of a way to find intrinsic value. And this video hopefully is going to be under 25 minutes, maybe 30, but I want you to know that intrinsic value is not that simple. In fact, when I start getting serious with a company, I will spend weeks, if not months, trying to figure out the intrinsic value of a company. And if it's taken me months, I'm probably going to take a pass. There is a lot more that is baked into valuation, but this video is to serve as a very high level understanding of how discounted cash flows and discounted earnings work. Okay, I lied. There is one more thing I need to say before we get over to the computer. And that's that recently on my Baba video, a really cool viewer commented saying that I was lowballing my valuation with Alibaba and that I wasn't factoring in a lot of other growth opportunities that Alibaba has in the works, like with cloud computing and many of their other investments that they have. And I completely agree with him. However, I did say in the video that I was valuing the company based off of my circle of competence. I don't know much about cloud computing and I don't know much about the investments that they have, but I do know quite a bit about e-commerce and Alibaba's e-commerce platform. So I was valuing it based off of what I knew. Reason I am saying this, guys, is that because if you want to come up with an accurate intrinsic value of a company, you have to understand the business. You have to understand what the growth rates mean, how and what each segment did to get the company's revenues to where they are today. Just keep that in mind. Know your circle of competence, because if you don't, you can plug and chug all you want, but the numbers will be absolutely meaningless. And also, I love constructive criticism. I love it when viewers comment on my videos and call me out. It makes me better and it makes me learn. So always feel free to do that. But with that said, let's go on over to the computer. What's going on, guys? Let's get right into it. So if you watch my Baba video, this looks really familiar, and we're going to go through it really quickly. And I'm going to touch on some things that I didn't get to touch on in the Baba video. But then, as promised, I do want to talk about the Rule 1 valuation, which I think is interesting. So we're going to do Facebook, a company that we all know and love. Well, maybe you don't love it. If you're like me, you think it's addicting and stupid. But I do have a lot of experience with Facebook. I used to do digital marketing, and I can't tell you how many campaigns I have run on Facebook. And I have read the 2019 10K. I haven't read the 2021. But in the 2019 one, they were talking about a lot of things that are in the works with R&D. So I do have some kind of up-to-date knowledge. But first thing we're going to need is that enterprise value. So we're just going to go here, valuation. And again, this is Ticker Terminal. I will put a link in the description if you want to check it out. It is in its beta mode. I'm assuming that later on this year, it will be a subscription service. But for now, it's free, so use it up while it is. And we're going to pull this total enterprise value, $805.7 billion. Put that there. The next thing we need to know is the free cash flow. So we're going to go to the cash flow statement, financials, cash flow statement, scroll down, and I am going to use the trailing 12-month number here. So cash from operations is how we figure out free cash flow minus capital expenditures. Now, if you are like me and you are lazy, another way you can figure that number out is you can go to Morningstar, go to key ratios, then this tab will pop up, and it's going to say free cash flow. You just pull that number. One quick note that I didn't get to mention in the BABA video, what if this is a cyclical company like oil? And what if, you know, what happened last year where oil prices hit an all-time low, per barrel at least, and you use that trailing 12-month number? Well, that's going to be terrible because that's not indicative of what the business can do throughout a business cycle. So if you're dealing with a cyclical company, which I try to stay away from those because they're hard to value, at least for me, you should consider normalizing it. And what I do to normalize, there's a lot of fancy ways you can do it, but I think a really simple way is just to take the last 10 years and figure out what the average is. That's a good way to figure out what the free cash flow is over an entire business cycle. 10 years is more than enough time. The next big question is the growth rate. And I know that if anyone who is watching this who owns Facebook stock is probably going to get really mad at me right now, because you think it's going to be a lot higher than 15%, and you might have some points. I read the 10K, and they have some really cool things that they're working on with respect to, you know, their marketplace features, and well, I could go on and on, like with their advertising capabilities. Essentially, they're trying to be more creepy. But anyways, the reason I'm going low is because if you look at sales growth, it's been phenomenal, but unfortunately it is going down. And I thought about using a 20% growth rate, but you know, I have to be disciplined in my valuations. That's the way I was educated based off of all the books I've read, and I have to be conservative. So I'm still going to try and make it work. We're going to do 15% through years 1 through 5, and then 13%. Honestly, probably should be more like 10, 7%, but I'm being kind to Facebook today. So the next big question is our discount rate. So here's some good news. Facebook is a great company, right? It's all green, which I said in the BABA video. If it's like that, you can think about it like a credit score. So this is like an 800, 850 credit score. So there's less risk, right? You don't need to demand as much of a premium on our return. Normally I do 15%, but we'll give them the benefit of the doubt. So we're going to go 10%. But one thing I wanted to say is, like, look what happens when we do 15%. Do you see it went down in value? I mean, that's how big of a deal this discount rate is. How big of a deal this discount rate is. And you really want to think about that and what rate of return you need for this investment to make sense, because, well, there's pretty big discrepancies in the numbers based off of how much you want to discount these cash flows back. But the next thing we need is our terminal value. So I said, again, in the BABA video, I feel like I'm repeating myself, that Monish Pabrai recommends a terminal value of 10, but he also says if it is a wonderful company, you can go up to 15. So we're going to go with a 15, and that's also because they have a strong moat. And, you know, like, is there any other Facebooks out there? There's Twitter, Google's a competitor, but there's a lot of barriers to entry. I don't see another Facebook coming anytime soon. So we can demand a premium on that multiple of free cash flow in year 10. So next thing we need is our debt. It's going to go to balance sheet. If you're using ticker terminal, you just scroll all the way down, and you're going to pull this number, 11.1 billion. You're just going to plug that baby right in there. And then we're going to do our cash and short-term equivalents. What are short-term equivalents, guys? Well, these are investments and anything that can be liquidated quickly to turn into cash if the company needed it. Facebook doesn't need it. They're basically a software company, tech company. They don't have a lot of overhead, so that they're just a cash generating machine. But if for whatever reason they needed to liquidate, they have a lot of investments that can turn into cash quickly. So we are going to treat it as cash. If you're Ben Graham and you read The Intelligent Investor, he wouldn't do that. He would only use just pure cash. But we are modern day value investors. We do not live during the Great Depression in the 20s and 30s. So we are going to treat it like cash. Next thing you need is shares outstanding. So we're just going to go down on the balance sheet. And that's right there, 2847. plug that in, and then you can see what we come up with over here. So we're taking this free cash flow number, cash from operations minus capex, growing it by 15% in years 1 through 5, 13% through 6 through 10. Might want to go down on that based off of what we just saw, but being nice here. And then we're going to discount it back to present value with our minimal accepted rate of return, 10%. And then the intrinsic value is the sum of the present value of all these cash flows plus our net cash, net debt position. Facebook has more cash, so they get rewarded for that in the valuation. It makes them safer because they have very minimal debt. So we get to bake that into the cake for our valuation here. So we're going to add back our net cash position to the enterprise value. And if you want to figure it out on a per share basis, you can, and it comes out to 262. If you read analyst reports, they are going to laugh at that. They're going to think the stock price is worth a lot more. And guys, that's where you have to be a disciplined investor, right? You can't follow the herd. You can't be persuaded. This is the intrinsic value assessment that I came up with. If I read a bunch of analyst reports and saw that, they think it's worth 350, 400, I would be tempted to buy it because of the herd mentality. That's what everyone else is doing, and I wouldn't want to miss out. But if you're a disciplined value investor, you have to trust your gut. You have to know the industry, and you have to understand the growth rates. So, went on a tangent there, but I can't emphasize that enough. And you might think Facebook is worth more, and that is really cool. I think that's great, and you can tell me I'm wrong, and I will love it. I want to learn. So if you think it's worth higher, if you think it demands a higher growth rate, leave a comment, let me know. I would like to know more about Facebook. But now I want to get into the Philtown Rule 1 valuation. And I'll be really honest, guys, I don't really make decisions based off of this valuation technique anymore. I still use it. I most certainly do. But after reading like 100 books on some of the best value investors, I've come to learn that the discounted cash flow and the 10 cap valuation, which I talked on in the previous video, are kind of the most common ways of valuing companies. But I still do use this. It is near and dear to my heart. It's where I started. So anyways, the first thing we actually need to know is a growth rate. And in the book by Philtown, he says the most important growth rate is this book value plus dividend growth rate, or the equity growth rate. How well is management growing your ownership as a shareholder? And he recommends using the 10-year number, so it's going to be this number right here. We're not going to use that number. That is very high, and you can see that it's been going down, right? But if this is a more mature company, you could argue Facebook's mature, but it's probably still growing. But if this has been a company like Microsoft, you'll see this will be very even. It won't be going down like this. So according to this subscription service, which if you start nerding out really hard and you start getting into this, I recommend it. It's $30 per month. Or if you don't want to buy this because you realize $30 compounded is a lot of money in the future, you can just use this compounded annual growth rate calculator I made for you here. I'm no Excel wizard, even though it might look like it, or maybe it doesn't. But you have to enter in this first term as a negative. So we're going to do exactly how Philtown tells us how to do it. So we're going to look at equity to figure out this growth rate. So we're going to go to balance sheet, and we're going to go back 10 years. So in 10 years ago for Facebook, equity was 4.9 billion. And then we're going to use this trailing 12-month number, which that is what Philtown recommends you use. Now you need to do terms in between. So if you're doing 10 years, you're going to do 9 right here. And you're going to get your compounded annual growth rate. That is really high. So you have a question that you're going to have to answer. Do I want to use that growth rate? And this is kind of where my beef with the Philtown valuation technique comes into play, because he says you should use that number. Guys, that's not sustainable. It's just not. So I'm going to cap it at 20%. If you want to do the 44%, just like his formula, go for it. So we're going to use 20% right here for our growth rate. And we are going to value this out 10 years. Now, the thing I want to talk about, and this is the big difference between the Rule 1 valuation technique and the discounted cash flow, is that you are valuing the company on a per share basis, on an earnings per share basis. So here, we valued the company on its enterprise value and free cash flow. We are not doing that with the Rule 1 strategy. So the way you do it is you go to the balance sheet and you want to know what the earnings per share is. So you're just going to scroll down and you're going to go diluted EPS. Looks like I need to update it. And Phil Town in the book says you want to use this trailing 12-month number. So also, real quick, another way you can do it is you can just go to Morningstar earnings per share. It's going to pop up right there if you don't want to use tickers. So we're just going to put in -10. If you get mad at me for not putting in the 9 cents, go away. Don't watch any of my videos. That's annoying. And then you can see here, there's a function Excel for figuring out the future value. I'll let you dig into that on your own time if you want to understand the mathematics there. And partially because I'm really bad at teaching still. I don't really know how to explain that yet. I understand the concept, I just don't know how to put it into words. But anyways, we need to come up with a terminal PE. So this is just like coming up with the terminal value. Now, Phil Town says you can be a lot more liberal with this. And I think he probably has a point. Because here you're coming up with a terminal PE, that PE ratio in the future on an earnings per share basis. Here in the discounted cash flow, this was a terminal value on free cash flow. So it's not quite earnings. Therefore, it's going to be a little bit lower. We're going to do it on the earnings per share. Now, how do you figure out what terminal PE you should do? And I do actually really like what Phil Town says here. So the way you figure out a future or a forward PE, as it's called, that's how the analysts say it, a forward multiple. Phil Town says you just go into like MSN Money and you go to quote, type in Facebook, click on analysis, price ratios, and you're going to take an average of the 5-year high and 5-year low. And I already did this, I already prepped it, and I came up with 25. And if you look historically, Facebook has always traded around a 25 PE ratio. It might be a little higher right now, but it's interesting because that's actually pretty accurate. So that's a good rule of thumb. If you want to get a good estimate of what forward multiple you want to slap on this, just take 5-year high, 5-year low, add them together, divide by 2, obviously. Then you're going to figure out how far out you're going to want to value this. And then classic Phil Town style, 15%. And I know I've been kind of ragging on Phil Town so far, but this has stuck with me. I still, to this day, do use a 15% discount rate for just about everything except in the occasions where it's like it's an Alibaba or a Facebook. I will go down to 10. But 15%, that's what we're going to do. So if you are valuing Facebook on earnings per share, not cash flow, big difference, you're coming up with an intrinsic value of almost $400 a share. So if you had beef with me in the discounted cash flow valuation, maybe you'll like me a little more if you see it on an EPS valuation. And you'll see that those are two completely different numbers. So you're gonna have to ask yourself which strategy works best for you. I'd say valuing a company on earnings like this is totally fine. The one thing I would advise you to look at before you do this is to look at a ratio in Morningstar. I think this is really cool. You go to cash flow and you look at the free cash flow to net income. If it is around a 1, that is solid. You can use this valuation technique because that means the accounting jargon isn't being manipulated. But if you go to something like Tesla and you go to cash flow and you see it's all over the place, 4, -0.23, 2.11, it's a lot harder to predict what the earnings are going to be relative to the cash flow. You see that a lot in growth companies. Personally, if I see this all over the place, I'm not going to use the Philtown valuation. But if it's around a 1, it doesn't have to be exactly 1, but if it's around a 1 and it's been like that for the past 10 years, I will definitely use the Philtown valuation. I can get into why that ratio matters, but for the sake of time, just trust me. If it's around a 1, you're good. If it's not, don't even think about it. So in the book, Philtown, for whatever reason, doesn't like to use the term fair value. He likes to use the term sticker value or sticker price. Like if you were to go buy a car, you'd see a sticker on the window and that's the price. But what I really do love about Philtown's book is he emphasizes the margin of safety. So essentially what we're gonna do is we're gonna take this sticker price and multiply it by our margin of safety, 50%, and that is the price at which Philtown thinks this would be a buy. He won't buy it unless it's selling for that. Now, this is not in the Rule 1 book. I want to make that very clear. This is not Philtown, but I think it's something to consider. So I'm a member, not a member, I'm part of the message board on Corner of Berkshire and Fairfax, and I saw something really interesting. And this guy said the Philtown valuation is great, but you should consider the cash and debt position. So once you figure out this number, the sticker price and the margin of safety, look at the cash and debt position and the shares, because that's going to impact the value on a per share basis as well. So what we're going to do, and for Facebook, this is a good thing because they have more cash, right? So it's going to actually increase our value. But if it had a lot of debt, it's going to decrease the value of the stock. So you're just going to take the total cash, just like I showed you in the DCF model, total debt, total shares outstanding, and then we're going to do a balance sheet adjustment on a per share basis. So because they have more cash, we can give them the benefit of the doubt and actually add that back to our valuation here because they're doing a great job. They're managing their debt loads, producing a lot of cash. So we can add $18 per share to our valuation. So the true fair value is, or sticker price, is $400, and our true margin of safety is $200. So I know I went through that very quickly, guys, but I do think both of these valuation techniques are great. They both have their pros and cons. If you are brand new to valuation, I would recommend the Philtown style. Start with learning about what earnings are, because the discounted cash flow, like if you don't know what free cash flow means, you know, you can plug and chug as much as you want, but in my opinion, if you're brand new to investing, it's a lot easier to understand earnings per share than it is free cash flow per share. So yeah, guys, I'm going to make the spreadsheet available, link in description. This is not financial advice. I'm a moron. Don't do anything based off of these numbers. But yeah, have fun with it, guys. If you want me to make another video on this that goes into this more detail, I know I kind of had to rush it because of time. Let me know. But anyways, guys, you guys are awesome. Thank you so much for taking the time to watch this, and I will see you guys all in the next video.